Hey everyone, Farhan here. So today you'll solve question number 9 from 2014 past exam. I know many students are facing problems with the topic of budgeting, mainly the reconstruction of ledger accounts for complicated questions and then using the results to prepare the budgeted financial statements, such as the income statement, the balance sheet, and the cash flow statement. In this question, we will specifically do the reconstruction for accounts receivable, inventory, and the disposal of asset. Then we will prepare the cash flow statement. At the end of this video, there will be an action call to check the 2 links in the description and book a call to discuss your tutoring requirements. So with that being said, let's begin. So Luz Lighting reports and budgets on a monthly basis. The business has been preparing its budgets for July 2014 and has completed the budgeted balance sheet and budgeted income statement. Luz Lighting now wishes to prepare a cash flow statement for July 2014. So here we have a business which reports on a monthly basis, and we are given the actual balance sheet for the month ending 30 June 2014 and the budgeted balance sheet for 31 July 2014. Then you can see we are given the income statement for the month ending 31 July 2014 and other information. We are also given the GST clearing account, and the requirement of the first question is to reconstruct the ledger accounts for the month of July 2014 for debtors control, who are now what we refer to as the accounts receivable. And then we have the stock control, which is what we now refer to as inventory, and the disposal of equipment. So let's start with the first additional information that we have. All sales are on credit and all purchases of stock are made on a cash basis. Cost of sales is 50% of sales. So we understand that the sales figure that we are given here in the income statement of $202,000, all of these are on credit. This means these sales are part of our accounts receivable, because since these are all credit sales and accounts receivable of the credit customers of the business, we need to reflect the sales within the accounts receivable ledger account. Now, the GST on the sales should be calculated at 10% of the original sales amount of $202,000, which is $20,200. Now, if you check the GST clearing account, which is a liability account, on the credit side of the ledger account, you will see that for the month ending 31 July 2014, we have made credit sales and we expect to collect GST on this credit sales of $20,200 from our debtors, who are now what we call as accounts receivable. So the sales, including GST, will be $202,000 being the original amount, plus the GST of $20,200, which altogether gives us $222,200. Then you also have the sales returns, which is what you'll find within the income statement, and that is $1,500, right? Now, whenever there is a sales returns, we also need to reduce the GST that we expect to collect from these sales. So the GST on the sales would have been $150, which would have been calculated by multiplying 10% on 1,500. So altogether, the sales returns calculation, including GST, would give us $1,650. Okay. Now, how do we show this within the accounts receivable ledger account? So let's check what we are given. So to begin with, we have the accounts receivable account, which is what we know to be an asset account. The reason this is an asset account because these are the credit customers of the business, and at some point in the future, we expect to get cash from these people. So the opening balance needs to be on the debit side because that's what we do with an asset account. So on the 1st of July 2014, we have the opening balance of $32,700, which is already given to us. Now we can verify this number by simply looking into the budgeted balance sheet figures and the actual balance sheet figures. So for the previous month ending 30 June 2014, you will see that within the current assets section, we had accounts receivable of $32,700 as the closing balance for June 2014, which is now what becomes the opening balance on 1st of July 2014. And that is what you are looking at, the reconstruction of ledger accounts here. Then for the month ending 31st of July 2014, the closing balance which we need to record on the credit side is $40,000. And again, this is taken from the forecasts, the balance sheet that we're given for the month ending 31 July 2014. So next we are including the sales, including the GST on the debit side. And that is $222,200, which is what we calculated based on the workings we've done here. Then on the credit side, we're including sales returns plus GST of $1,650 because when we have sales returns, our accounts receivable goes down. And when our accounts receivable goes down, we understand that our assets are going down because we expect to collect less cash from these people in the future. So when the assets go down, we have to show it as a credit within the ledger account, and that is what we're doing here for sales returns, including GST of $1,650. Then we have included the discount expense and the bad debts. These are the figures that we always expect to find within the income statement because both of these are expenses, and all expenses are reported within the income statement. So always be careful to double check the income statement and make sure no items are missing. So let's go into the income statement and you will see that we've got the discount expense of $1,500, which is what we understand to be a non-cash expense. And then we have bad debts of $2,200, which is also a non-cash expense. Now, bad debts here refers to the credit customers who are probably bankrupt and now cannot pay the business on credit sales that we have made to these customers in the past. So when these people have confirmed that they cannot make the payment, the asset is going down because we're not collecting the cash anyway. So when the asset goes down, we need to show it within the credit side, and that is why within the credit side, you're showing bad debts. Now, the main purpose of reconstructing any ledger accounts when you're working with budgeting is to either find the item that goes into the income statement or the balance sheet. Or in most cases, you will also see you need to find the missing item that needs to go into the cash flow statement, which is basically cash inflows and cash outflows, right? Now, in this question, we are required to calculate the cash inflow, which is the cash we expect to receive from these customers. And the way we do it is by simply balancing this account. So how do we balance this ledger account? We take a quick look and we can understand that the heavier side to begin with would be the debit side. So you add everything on the debit side, which gives us $254,900. And this must be the total on the credit side based on the fundamental rules of accounting, which needs to apply here. So once you have $254,900 as the total balance of everything on the credit side, then you can basically subtract the bad debts, the discount expense, the sales returns, including GST, and the closing balance. And the amount that you will get as the missing figure is $209,550. All right, so this number here refers to the cash that we expect to receive from our accounts receivable or customers in the month of July 2014. You do not really need to carry the opening balance, the closing balance forward as the opening balance on 1st of August because here you are just reconstructing the ledger accounts, but you can choose to do it based on the fact that if you are asked to complete a ledger account or prepare a ledger account from scratch, in that case, you must show the opening balance that is carried forward into the next financial year. Okay, so what do we have next? So next we have the cost of sales, which is part of the first additional information that mentions that all purchases of stock are made on a cash basis and cost of sales is 50% of sales. So we want to first find the net sales. So how do we find the net sales? Which is the gross sales of $202,000 minus the sales returns of $1,500. And that's how we get $200,500 as the net sales. Now, given that the question clearly mentions that cost of sales is 50% of sales, which is always the net sales, we just simply calculate 50% multiplied with net sales, and you get $100,250 as the net cost of sales based on the net sales figure that we had calculated earlier. Now, we know that all purchases of stock are made on a cash basis. This means neither of the balance sheet figures for the month of June and July should have any accounts payable. And if you want to have a quick look, you can verify that within the current liabilities section, we really do not have any accounts payable, which also verifies the fact that all purchases of inventory are on a cash basis. So what do we do with the inventory ledger account? So here you can see we're given the outline, and we understand that inventory is an asset account. So by default, all assets should have an opening balance on the debit side of the ledger account. So this is the debit side. So on the 1st of July 2014, we are showing the opening balance of $72,000, which must be the closing balance from 30 June 2014, right? So if you want to double check, you will see that is the case. So $72,000 was the closing balance at 30 June 2014. And then the closing balance is $9,000, which is what we are including here on the credit side. Then we are showing the cost of goods sold of $100,250, which is calculated based on the net sales figure. And this cost of goods sold simply refers to the fact that we have made some sales of inventory, and the cost of that inventory was $100,250. Now that we have got rid of this inventory because of the sales we have made, we have to reflect this reduction within the ledger account for inventory. So when the inventory is going down, an asset is going down, and when asset goes down, we have to credit it within the ledger account. So that is the main purpose of why the cost of goods sold is recorded on the credit side of the inventory account. That is $100,250. Now, always double check your income statement for any inventory gain or any inventory write-down. I believe if you are attempting your school assessed coursework, you may get a question where you have inventory gain and also inventory write-down. Both of them could be involved at the same time. So where can we check this information? Always look into the income statement, which is given, because inventory gain is an income account and inventory write-down or inventory loss is an expense account. So they are more likely to be reported within the income statement. So when you check the income statement, you will see that we have inventory write-down of $2,000. So inventory write-down of $2,000 is reducing the overall balance of inventory that we hold in the business, which means our assets are going down. And when assets are going down, we have to show it on the credit side of the inventory account, and that is what we are doing here. So inventory write-down $2,000 reported on the credit side of the inventory or stock control account. Then we are including stock drawings of $3,000 on the credit side. And this is based on whatever is given in the question. And this information was not given in the second information, but here, the third one. There will be no capital contributions during July, and drawings by the owner will include $3,000 of stock. So the owner is using $3,000 worth of inventory for personal use. This also reduces the balance of inventory we hold. And when the balance of inventory goes down, asset goes down. And that's why this drawings is reported on the credit side of the inventory ledger account. Now, the main purpose of reconstructing the inventory account was to find out the cash we have paid for the purchases of inventory, right? So how much cash have we paid for the purchases of inventory? So this is again done based on the balancing requirements for a ledger account. So you take a look and you know the heavier side is the credit side. So you add everything on the heavier side, which gives you $196,000 in total. Okay, and let me double check if it is $196,000 in total. So 90,000 plus 100,000 to 50 plus 2,000 plus 3,000. Actually, that is $195,250 in total. Okay, because I remember that we have calculated the cost of goods sold based on the net sales. So this needs to be corrected. So 195,250, which should be the same on the debit side as well, based on the fundamental rules of accounting. All right. So now that we have a total of 195,250 on the debit side, we subtract the opening balance of 72,000, and you should get $123,250 as the cash purchase of inventory for the month of July. All right, and to mention that this is cash, we are including bank here as the cross-reference. Okay, so cash paid for purchases of inventory is $123,250. All right. Okay, so next we have the disposal of equipment. So let's read the information number 2. So equipment costing $25,000 with a carrying amount of $9,800 will be sold for cash. All right. And then new equipment will also be purchased for cash. All right. So how do we find the carrying amount of any asset at a given point in time? So we take the original cost and then we subtract the accumulated depreciation. So in this question, we are already given the carrying amount of 9,800 and the original cost being 25,000. The accumulated depreciation is something we do not know straight away. So we have to use algebra, and based on algebra, we understand that the accumulated depreciation is the difference between the cost and the carrying amount. So we are subtracting $9,800 from 25,000, and you get $15,200 as the accumulated depreciation or the total depreciation or the total economic benefits that the business has consumed by utilizing this equipment. All right? Now, so we know the profit on disposal is given to be $3,700. And again, profit on disposal is an income, and any income is always reported in the income statement, which is what you can see in the question here. So profit on disposal of equipment is $3,700. All right. So this $3,700 for profit on disposal can be used to find the selling price of this equipment, which is the disposal proceeds. So given that we know the carrying amount to be 9,800 and we know that we have made a profit by selling this asset of $3,700 extra, that means if you want to find the disposal proceeds or the selling price, you just simply add the carrying amount and the profit on disposal, which is 9,800 plus 3,700, and you get $13,500 as the selling price for this asset. So whatever you're getting by selling this asset, which is the disposal proceeds, that is what we classify as cash inflow, mainly inflow because you're selling it and you're getting cash as exchange. So cash inflow for investing activities. And the reason this is an investing activity is because we are dealing with a non-current asset. When you do the cash flow from investing activities section for the cash flow statement, you are only dealing with non-current assets that you have sold and non-current assets that you have purchased. Okay, so this is a cash inflow for investing activity, and that is $13,500. Then we have the purchase of equipment. Now, let's check the balance sheet, all right? So if you check the balance sheet for equipment, you will see that the change in between month of June and July is by an additional $5,000. So we had $37,000 worth of equipment at cost at the end of 30 June 2014, but at the end of 31 July 2014, we have $42,000, okay? And we need to use some logic to understand what's going on and solve the purchase price for the new equipment. Okay, so let's start with this. So we know that to begin the month of July, we started with $37,000 worth of equipment at cost. Okay, and then we sold an old equipment which had an original cost of $25,000. Right? The question clearly mentions in point number 2 that the old equipment had a cost of $25,000, right? So when we dispose the old equipment, we're getting rid of it. So that's why we have to subtract it. So that's why you see a minus here. So we start with the opening value of equipment of $37,000. Then we subtract the $25,000 for equipment that we have sold. And then I'm adding X, so plus X. So the X here is referring to the purchase of new equipment, all right? And that should give you $42,000 as the balance you have at end of 31 July 2014 based on the balance sheet, okay? So if you just simply solve for X, 37,000 minus 25,000 gives us 12,000 plus X equal 42,000. And then if you want to find X, it's simply 42,000 minus 12,000, and that gives us $30,000. So this $30,000 is the purchase price for new equipment, which means this is the cash we have paid to purchase the new equipment. The question explicitly mentions equipment will be purchased for cash, okay? So this is a cash outflow, mainly an outflow, and again, this is to be reported within the investing activity of the cash flow statement. So when you prepare the investing activity section for the cash flow statement, you need to show purchase of new asset minus 30,000, and then underneath you show disposal of equipment plus 13,500, which is an inflow. Okay. All right. So what's next? So next we have the loan. So the loan requires one repayment on 14 July each year. Okay, so we need to understand what's going on here. So you see, within the non-current liabilities section, we are given a loan. So anything that is reported, any loan that is reported within the non-current liability section, this loan is not due within the next 12 months, but after the next 12 months, right? That is why we call this a non-current liability. So at end of 30 June 2014, we had $22,500 as the balance for this non-current liability, but at end of 31 July 2014, we expect to have $80,750. The reduction of $3,750 is what we look forward to pay in next year, which is 2015 July. All right. So that is why this reduction of $3,750 is reported here as a current liability, which is due in the next 12 months, and that is in July 2015. But if you check the current liabilities loan for 30 June 2014 of $3,750, this would have already been paid. We understand that every year we make one repayment. So this $3,750 would already be paid on 14 July 2014 this year, right? Based on what the question mentions. The loan requires one repayment on 14 July each year. So the current liability we have at 30 June 2014 would have been paid off on 14 July 2014. So which means this loan that we are paying in the month of July of $3,750, this is a financing cash flow, mainly a financing cash outflow. The reason we call this a financing cash flow is because this loan would have been used in the business for helping the business finance its regular operations. So this was part of investment within the business. So that is why this is called a financing cash flow. Now, after the loan is taken care of, we see that we have got the information for GST, which says that for the month of July, we have the GST clearing account here. No payments to or refunds from the taxation office are expected in July. Okay, that is pretty straightforward. So we understand we have done the reconstruction for accounts receivable and inventory, but we haven't done the reconstruction for disposal of equipment. I apologize, I shouldn't have moved forward to loan. So let me just walk you through the disposal of equipment. Now, this is a format that you may memorize, but let's see what's going on here. So you can see on the debit side, on the 1st of July, we must show the asset at cost, and that is $25,000. And on the credit side, you are to show the total depreciation of that asset, which we have disposed. And that is what we calculated just at the very beginning, which was $15,200. So let's include that here. Right? Then we know that we are receiving $30,500 by disposing this asset, which is what we're reporting on the credit side. And then we know that we have a profit on disposal of $3,700, which is what we're reporting on the debit side. Now, this is mainly the format of the disposal of equipment account, which you can memorize, where you show the asset at cost on the debit side and the total depreciation on the credit side and the payment you're receiving on the credit side. And if you make a profit, you show that on the debit side. And if you make a loss, you show that on the credit side. Okay? But there's also some other logic on how this all makes sense. So let me just quickly show you one of them. So for example, why do you think the payment that we have received of $13,500 in cash that is reported on the credit side? Because when we receive the payment by disposing this asset, how do we journalize this? So we are receiving the payment, means our bank balance is going up. So we would debit bank, right? So we would debit bank by $13,500 because our asset is going up. And then what would we have credited? So we would have credited the disposal of asset account, all right, by $13,500. So the fact that we would have credited the disposal of asset account by $13,500, which is cross-referenced with funds that we have received in the bank account. So that is why you can see here on the ledger account for disposal of equipment on the credit side, you are showing bank of $30,500. Okay. So this is one way to look into this. But you can memorize this, and in most cases, you should be able to get full marks given that you have derived the numbers accurately. So how about the balancing here? So I believe you understand what's going on. You just simply add everything, and you should be getting $28,700 on both sides. Okay, so let's see what else do we have to calculate. Now, I recommend every time you are working with budgeted financial statements, mainly the cash flow statement, you make sure to double check the current assets and current liabilities within the balance sheet. Okay, and because in most cases you can have expenses which are prepaid, or in most cases you can also have expenses which are still accrued or which haven't been still paid. Okay, so let's see what's going on. So starting with the current liability section, you can see that we've got accrued wages within the current liabilities. Okay, so we understand that accrued wages refers to wages expense that we have incurred and we haven't still paid for this in cash, which means we haven't paid our employees in cash. So how do we find out so you can see that for the accrued wages, there's a reduction from $2,500 in June to $1,500 in July. And then you can also see that we have been given the wages expense in the income statement of $27,000. But none of this really refer to the wages amount that we have paid for in cash. So that is something we look forward to calculate. And how do we do it? We again do a quick reconstruction of ledger account for accrued wages. So accrued wages is a liability account, and by default, all liabilities should have an opening balance on the credit side. So you can see on the 1st of July, we are given the opening balance of $2,500 on the credit side, which means the closing balance is on the debit side on 31st of July, and that is $1,500 based on the figures that we have been given in the balance sheet. Then during the year, you know that you have incurred, during the month, you have incurred additional wages expense of $27,000. So any wages expense that you would have incurred would have increased your liability. So therefore, your accrued wages would have gone up. And if your accrued wages would have gone up, we would have to credit it. So on the credit side, you can see for the month ending 31st of July, we are showing additional wages expense incurred of $27,000. So our main requirement in this question is to find out the wages that we have actually paid for in cash, given that we understand that our accrued wages have reduced from $2,500 in June to $1,500 at end of July, right? So how do we find out this missing figure? Again, you take a quick look and you know the heavier side is the credit side. So you add the total of everything on the credit side, which is $29,500, which must be the total of everything on the debit side. And once you subtract the closing balance of $1,500, you get $28,000, which refers to the payment we have made for wages using our funds in the bank account, which is also an operating cash flow. So when you prepare the operating activities section, you need to show wages paid of $28,000 as a cash outflow, which means you need to show that as a negative number. Okay? All right. So we do not have any accrued interest in the current liabilities section. So we only got accrued wages. So in the income statement, you can see that the interest expense is given of $1,100. So if we do not really have any accrued interest, which means we do not really owe any interest, this simply means that we have paid all the interest for cash. So the interest expense of $1,100 is also the interest paid, and this is an operating cash outflow, which is to be reported within the cash flow statement. Okay, so the purpose of mainly checking the balance sheet, as I was mentioning earlier, for current assets and current liabilities is with regards to the expenses that have been shown in the income statement. So your job is to make sure those expenses which we know that we can deal for cash do we have any prepaid or any accrued stuff relevant to these expenses? So always double check, okay? All right, so next we have got advertising in the income statement, advertising expense of $9,300. And if you check the balance sheet, you will see that within the current assets section, we have got prepaid advertising, nothing at 30 June 2014, which is zero, but we have got $3,000 of prepaid advertising at 31 July 2014, okay? So prepaid advertising of $3,000 at 31 July 2014. And we know advertising expense reported to be $9,300 within the income statement. So if you get this right, you know total advertising that you would have paid for in cash would have been 9,300 plus 3,000, which is 12,300. We can do this simply based on the fact that we do not really have any accurate advertising, and any prepaid advertising simply means that you have used up cash. And since we do not have any accurate advertising, so whatever advertising expenses reported in the income statement should also be paid for in cash. But if that sounds still confusing, let's look into this from the perspective of the reconstruction. So prepaid advertising is an asset account, right? Mainly a current asset account. So all assets by default should have an opening balance on the debit side. So within the debit side, for the month beginning 1st of July, we have opening balance of 0 based on what you saw earlier. And on the credit side, we're showing the closing balance of $3,000. Okay. During the month, we have advertising expense of $9,300, which refers to the advertising expense in card, and any expense in card will basically reduce the balance of the prepaid advertising, which refers to the consumption of economic benefits that come with the prepaid advertising asset account. So when we have advertising expense, it reduces this economic benefit, which means assets are going down. And if prepaid advertising, which is the asset, is going down, we have to credit it. So on the credit side, you can see advertising expense of $9,300. All right. So how do we balance this? So we find the total of everything on the credit side, which is 12,300, and that must be the total of everything on the debit side. So being the opening balance given as 0, you only can bring down $12,300, which refers to the advertising that you would have paid for in cash in the month of 31st of July. Okay, so this is referring to advertising paid for cash of 12,300, and this is to be reported as an operating cash outflow because this is part of your regular operations of the business. Okay. All right, so what else do we have? Let's look into the budgeted cash flow statement, and then we'll come to this discussion for the cash drawings. All right, so the budgeted cash flow statement, we're starting with the operating activities. So first, we include the cash received from our customers, our accounts receivable, and that is $209,550. As you can see here, based on our calculations, so $209,550. Then we have included inventory purchases and within brackets referring cash outflow. And this was on the basis of our calculation from the inventory ledger account. Then we know we have paid GST 17,865, the negative number, because it's a cash outflow. And how do we know we have paid GST? Check the GST clearing liability account, and GST paid is always shown on the debit side of the GST clearing account. And GST collected or expected to be collected is shown on the credit side. So look for the GST paid on the debit side, which is 17,865, as you can see here. We know this is paid because it clearly mentions bank as the cross-reference, okay? So this is 17,865 taken from the GST clearing account. Then we have advertising paid of $12,300 in negative, which is just what we derived a while ago. Then we have interest paid of $1,100. We did not have any accrued interest. Normally, you can expect to find accrued interest in questions like this. Then we have got wages paid of $28,000, which was based on the calculations and the numbers we have used for accrued wages given in the balance sheet and the expense in the income statement. So that's what we have here. Then we have included other expenses of $14,100 because within the current liabilities or the current assets section, we do not really have any prepaid or any accrued expense relevant to this other expenses. So we are assuming this other expenses of $14,100 is entirely paid for in cash. Okay, so that is what you can see here. So because this is a cash outflow, this is a negative number here. So you just simply plus minus whatever you've got here, and you should get negative 12,935, which is the net cash from operations. Okay. net cash from operations of $12,935, and this is a negative number. We do not include discount expense or bad debts, even though they're part of your regular operations, because both of them are non-cash expenses. The same thing applies to profit and disposal. It's a non-cash income. There's not really any cash coming into you just because you've made the profit. The cash is coming from the entire selling price, right? But the profit itself is classified to be non-cash gain or non-cash income. Same thing applies with inventory write-down, which just reduces the balance of the asset. It is not really a non-cash expense. Or inventory gain, which is just, which is not, inventory write-down, which is a non-cash expense, and inventory gain, which is a non-cash income. So there's really no cash involved here, okay? So then we have shown the investing activities. So purchase of equipment of $30,000 negative, which is what we derive based on the algebra calculations we have done. All right. So we have got the purchase price of the equipment to be $30,000, and this is a cash outflow for investing purposes. And then we have got disposal proceeds of $30,500 shown as a positive number because it's a cash inflow, because it's the price that you get by getting rid of the asset. So we get net cash from investing of negative $16,500, obviously because you have spent more to buy an asset than what you have got by selling it. And then we start the financing activities. First of all, we know that the loan paid is $3,750, and then we have got drawings. So what about the drawings? So we know based on the information given in the question, there are no capital contributions, and we have got inventory drawings of $3,000 during the month. If you check the balance sheet, you'll find the drawings for July to be $32,000, as you can see here. So drawings in July is $32,000, while drawings in June was $44,000. So we mainly focused on the month of June. So if the drawings for July is $32,000, and given that out of the $32,000, $3,000 refers to inventory drawings or stock drawings, then we understand that the cash drawings would be the difference between $32,000 and $3,000, which is $29,000. Now, this cash drawings has a direct impact on the investment that's available for business purposes. So we can call this a financing cash flow. So mainly a financing cash outflow because we're withdrawing money from the business. We're taking money out of the business. So within the financing activities section, you report the drawings as a negative number, cash drawings of $29,000, loan paid of $3,750, both in negative, and that gives us net cash from financing to be $32,750 negative. So what's going on? So we have got negative numbers for operating, negative for investing, and negative for financing. So if you add all these three together, you should get net deficit in cash of $36,350. So during this month, you have more expenditure in terms of cash. You have more cash outflow than inflow, and that is $36,315 negative. Then you add the opening balance, which is $27,320 positive, referring to an asset. And you can see at end of 30 June 2014, we had cash at bank as an asset of $27,320. All right. So that is what we're adding here. So minus 36,315 plus 27,320 gives us negative $8,995 as the closing balance we expect to have at end of 31 July 2014. So this negative $8,995 is what we refer to as a bank overdraft, which is a current liability, meaning that the business does not have any money in the bank account, rather it owes the money, some $8,995. And because we're given the balance sheet, we can verify whether this figure is correct, and you can know whether or not your math is correct. So when you check the balance sheet, you will see that within the current liabilities section, you're given cash at bank again as an overdraft for the month ending 31 July 2014, and that's $8,995. Right? Okay. So, all right. So I think that's all for part A and part B. All right. So I was just curious regarding calculating the GST that we have paid for in cash, which is what you can see here, given for the month ending 31 July to be $17,865. So this is not really a requirement for the question, but I don't really get 70,865, but 70,965. You don't need to worry about it, but let me just quickly run you through this. So how did I find 12,325? So this 12,325 is the GST we pay for inventory purchases, and this was calculated based on 10% multiplied by $123,250, which is the amount we would have paid for cash when buying inventory. So the GST obviously would be 10% of that, right? And that should give us 12,325. Then this $1,230 is basically 10% multiply 12,300, which is the total amount we have paid for advertising, right? So if advertising is a service, given that advertising is a service, we obviously have GST involved, and that would have been 10% of the total amount we pay, and that should be 1,230. And then 1,410. So this is basically I'm expecting the other expenses, which is 14,100. It comes from there. So we do not really know what these other expenses refer to, but I'm expecting this could be relevant to some form of services, right? So 10% of 14,100, and that's 1,410. And lastly, we have got $3,000 here, and that is basically from the purchase of equipment, which we paid for in cash, worth 30,000, if you recall, and 10% of that would have been 3,000. So altogether, you get 70,965. So I was just wondering, the fact that they have mentioned 70,865 here, so where is the other 100? Or if I've done something wrong, which I don't believe so. But you don't really have to worry about it. It's just if you like accounting and if you love accounting and you want to know how the numbers add up together, you can try it out. All right, so what's the last question we've got? So we have got a discussion question which says that explain giving two examples other than the loan repayment and drawings, which is what you would have seen in the financing activities section, how the business can budget for a net profit of 43,550 yet have its budgeted bank balance fall. As you can see, the budgeted net profit of 43,550. Okay, now we can look into many points. It should be easy for you to write. So for example, the advertising paid that we would have reported within the cash flow statement, that would have been $12,300 negative, right? But the advertising expense, which refers to the actual economic benefits that we have consumed during the month of July, was 9,300. So there you can see we have a difference in number where we're paying more cash and we're reporting less expenses, which is increasing the profit. Then you've got inventory purchases. So the inventory purchases we report within the operating activities section are $123,250, right? And then you also have the GST that comes with it. But we reported a cost of goods sold of $100,250 on a net basis within the income statement. So the cost of goods sold being lower than the inventory purchases, this means that the profit would have been reported higher, okay? Again, if you check the GST clearing account, you understand that we have paid more GST than we have actually collected in cash, because on the credit side of the GST clearing account, we have $20,200, which is referring to expected collections. These are not really collected yet because these are tied to the credit customers of the business, right? The debtors control, the credit customers. And then you can look into purchase of equipment, which is the investment in a non-current asset, and that would have been recorded in the balance sheet. This is not part of the income statement. So this is a substantial difference in the numbers, right? So purchase of equipment, $30,000 outflow would have significantly reduced the balance that is available as per the cash flow statement. Okay, so here are a few points you can touch on and then talk about, and you should be able to get full marks, which I truly believe so. So that's all for today's lesson. Before you go, you can check the link in the description. So there are two links. One link for your individual tutoring requirements, which you can book and have a chat with me. You can bring your parents and have a Zoom call with me and discuss what you need help with before the exam comes in 2 months. And there is a group link for a class that we are doing on budgeting. So this class will cover the reconstruction of a few ledger accounts. We're going to work with a mainly very complicated question, which is going to be a 25-mark question, and we expect something similar to be coming in your main exam. And the main outcome of the class is you will have a good understanding of the reconstruction of ledger accounts. We will also learn to prepare the budgeted income statement, budgeted balance sheet, budgeted cash flow statement, and we will also discuss the ethical requirements that are associated with the case that we'll be working on. So this is a 90-minute class, which is happening in 2 weeks' time, and this is only limited to 8 people. So make sure to check the link for the group class on budgeting, and I'll see you soon.